All right, what up, traders? This is Jeremy from Escape Velocity Trading coming at you for a market bias update report for Sunday, August 11th. Reviewing trading from the previous week, I ended up having 8 wins and 5 losses. My losses ended up being slightly larger overall than my gains, unfortunately. Ended up losing back about $500 to the market. And this marks about the 6th week that I have just had subpar performance. So went back through, reviewed my trading journals again, spent some time again over the weekend trying to figure out what is going on. And I kind of feel silly at this point because my read on the market has been fairly accurate from week to week. When I went back and looked through the videos that I've been putting out and what my analysis was going into the trading week, we have basically played out how I have called my shots on the last videos for the last 4 or 5 weeks here, but my timing has just been off. And if we go into an intraday chart, so let's dive in here to like a 1-hour chart and just look at the last week of trading data. So this is on the S&P 500. We had a breakout right here. I triggered in on this breakout, immediately got stuffed out and then tapped out for a loss. Again, waited. We got another breakout confirmation here, tapped into the trade, immediately got stuffed out. And this has been the theme not only on the S&P 500, but on multiple different asset classes that I've tried to trade this week. And even though our analysis on the daily and weekly chart has done what we have wanted it to do, the intraday volatility has been a little bit too much for my normal trading system and the amount of buffer that I give each trade for my stop losses. And for anyone that doesn't understand the idea of ATR, before we actually go into the market bias update for this coming week, I want to show the ATR here. So ATR stands for average true range. And basically that is just a fancy word for what is the average price movement per day. So what this does is it goes through and it averages the price movement of the last 14 candles, and it plots the number of that average, showing how much money plus or minus the S&P 500 makes or loses on average per day. What is the total range average per day? And you can see here that the entire last 6 months, we have been below 72. And then all of a sudden we spiked up and we actually hit a high of about 107. So obviously much more volatility in the market. You can also just look at the chart and see that there is a lot more volatility. These candles are much larger than they have been for quite some time. Now, what that means is if you do not either scale down your position sizes or just wait out the volatility, if you try to participate, but you don't adjust your risk tolerance rules or your entry requirements for new trades, you are likely going to get whipsawed back and forth within these larger price movements because they are larger than normal. You just don't have the edge on that. So anyways, this has been kind of a theme for my trading for a little while now. Still up a little over $40,000 for the year, but it was at one point up almost 80K for the year, actually a little bit more than that. So bit frustrated to have given back so much of my gains so far this year, and moving forward, really just need to tighten up a lot in terms of specifically my entry requirements, because again, just getting whipsawed back and forth within this extra volatility is not fun and it can wreak havoc on your bank account. So with that update now behind us, let's go out and first look at our economic data coming down the pike for this trading week. Now, I cannot wait to get out of the trading environment that we are in, because the economic data that gets released constantly to the market has just been driving algorithmic responses, and it has made it really, really hard to catch normal trades. So this week is no different. We have an onslaught of economic data. Of all of these, honestly, core CPI data on Wednesday and the core retail sales on Thursday and the unemployment claims also on Thursday are kind of my top 3. The core PPI will also be important, but I'm not expecting that to move the market quite as much as the core PPI, or excuse me, core CPI. on Wednesday there. So Wednesday is really going to be the one that I am looking to make or break what happens this week. And then also the unemployment claims and core retail sales. The PPI is just going to be kind of a kicker, in my opinion. Going out to the market, we are in a very interesting spot right now. So obviously had a massive volatility come into the market here this last week. And for anyone that isn't familiar with the carry trade, that is basically the reason for this volatility. And the very, very short version is that because we are in a global economy, finances are impacted fairly drastically from what one Federal Reserve, let's say the US Federal Reserve, does versus what the Bank of Japan does or something in the European Union. All of these different fiscal policies impact the market as a whole. And specifically, the carry trade is basically where currency traders will borrow one currency that has a very low interest rate, in this case, the Japanese yen, which has basically had 0% interest rates for quite a while now. They will borrow that, paying next to nothing to borrow it. And then they will take that money and invest it into a currency like the US dollar that was currently paying about 5%. And so they will pocket the difference in the amount of interest they're getting paid on the money that they put into the US dollar that they borrowed from the Japanese yen. Now, what happened over the weekend on Sunday was the Bank of Japan announced that they were raising interest rates for the first time in a very, very long time. Now, what that means is anyone that borrowed money in the Japanese yen, excuse me, looking to put that money into a currency that paid a higher interest rate, now all of a sudden their profit and loss margins on that have shifted, and they had to close out that trade because the Japanese raising interest rates meant that that money that they had borrowed, they now have to pay a higher percent interest on to keep that trade open. Traders that got caught on the wrong side of this and had bad timing on it might have actually taken a significant loss. And that is how it spills over into the actual stock market itself, because if they take a loss on that trade, then they likely have to go and liquidate other holdings that they have in order to pay that debt. So in the futures market on Sunday, we had a large movement to the downside here. You can see we closed on Friday up at about 5,350, and then we gapped significantly lower and ran all the way down to 5,100 on the futures market. So looking at the week ahead, we are at a very, very crucial point in the marketplace. And right now, it is going to be hard to give a true read of whether or not we are moving higher from here or if we are moving back lower. So let's look at that and see what we can figure out. Right now, we are sitting basically right on top of the all-important momentum indicator, our 9 exponential moving average. We are overextended on the RSI and should see some continued upward movement in price based on the RSI. The MACD is in bearish territory and looks like it will cross back at some point here. The signal line and MACD line will cross each other, which is a bullish indication, but we are still in bearish territory on the MACD. So given all of that, looking at where we are currently in the market, I wouldn't be shocked by one of two scenarios. Either scenario one is we move higher, the 20 SMA shown in blue here continues to drift down, and somewhere probably around 54.30, that is kind of the line in the sand because it is where we found support right here on the daily chart. So somewhere right around that like 54.30, 54.35 zone is the upward resistance line if we do get a breakout from this 9 EMA and start to move higher. That is where I expect us to find a price ceiling and then retrace back down. If we can't hold the 9 EMA and we do push lower once again, I am guessing that we will probably find support somewhere down in the neighborhood of 5,200 to 5,250, somewhere right in that zone. So if we do get the move lower, looking for potential buying opportunity, potential double dip on the RSI being overextended to the downside, again, somewhere around 52 to 52.50. To the upside, if we do move up into 54.30, if we toss this to a weekly chart, that's still a daily chart. go out to a weekly chart, we can see that that actually lines up basically right at the weekly 9. So again, that kind of confirms that upward resistance around 54.30. If we do make a push higher into that, the best case scenario for the market would be for us to move higher and then do absolutely nothing. Just go sideways 2-3 days, get through some of the economic data on Tuesday and Wednesday, and then line up a potential breakout to the upside on Thursday or Friday of that 54.30 level. If we do move lower and find support down here, as long as the economic data doesn't come in terrible this week, again, finding support and then trying to move higher off the lows also would potentially look good. And that would really give us kind of a double bottom pattern here where we put in a low, came up, found resistance, came back down, tested the low, came back up to resistance, and then broke out. So again, lining up a breakout of about 5,400 by the time that rolls around. So those are kind of the levels to look for on the S&P. If we go out to the Nasdaq, basically rinse and repeat the exact same thing. Had a overly aggressive downside move, found support, came back up and retested and reclaimed the 200 period moving average on the daily chart. Again, sitting right at the 9 EMA. On the Nasdaq, I'm kind of assuming moving back up into the 18,900 level. If we go out to the weekly and look at where our moving averages are on the weekly chart, that would be 18,900 would be basically coming back up to our 20 period SMA, give the 9 EMA a chance to continue to grind lower, come back in and kind of converge in that same zone and line up a break either Thursday or Friday or sometime the following week, breaking out to the top side. So that would be the best case scenario for the bulls. Worst case scenario, we're probably coming back down and retesting around 17,900 or 18,000 if we have any kind of weakening in our economic data coming out Monday, Tuesday, Wednesday. Going out to the Russell. Russell, kind of a hot mess right now. Need to get back above 2120 probably on the daily chart and on the weekly chart. As long as we hold the current lows on the 20 SMA, really moving that up. 2120 still actually looks good on the weekly chart as well. That would get us back above our 9 EMA. So 2120 to the top side would be potential trigger in for the Russell. If we fail to break above that level, coming back down somewhere in the neighborhood of 2050 to 2030 on the downward side for the Russell 2000. Going out to the Dow Jones, it looks mighty similar to the Russell 2000 to me. Again, looking probably for a break above 39,800 on the top side on the weekly chart. That would confirm our 9 EMA as well. So basically getting back above the wick high from the previous week of trading and back above the weekly 9. That would look good for the Dow Jones. If we fail to claim that, back down to probably 39,000 is where I will start to get interested in looking for support to form, looking for bottoming patterns, and looking for a potential trade to the top side again. But again, that is just projection. At this point, we really need to see how the price develops at that level when we get there. Going out to Bitcoin, kind of a hot mess, oversold to the downside, have reclaimed the 200 period moving average, which is great. Now we're just kind of in no man's land. Again, would absolutely love to see us either go absolutely nowhere or to pull back into the 200 period moving average, retest that as support, and then move higher from there. Going out to crude light, now we have had a massive bounce off of the 72 area. We're back up to around 77. Nothing to see here. Even if we do continue higher, we have moved too far off of the lows for a significant trade. For this, we need some development, 3-4 days probably at least before I'll be interested in a trade here. Unless we fail to hold the 9 EMA on the next move lower, I could potentially be talked into shorting below 76. Going out to gold. Gold's just kind of chopping around here, not doing anything really that you can trigger on the daily chart. If we go to the weekly chart, honestly, this looks to me like we will probably come back to 2420 to 2400, somewhere in there. Doesn't look like it's quite ready for prime time yet, so needs some development on that. I wouldn't hate a retracement back down to 2400, going sideways for the rest of the week, and then moving higher from there. And finally, going out to silver. Silver's starting to clean itself up. I, again, would actually like it to come down and visit its lows again first before breaking out. If it does break out, coming back up to around 28.5, 28.45, somewhere right in there on the daily chart makes some sense to me. That would also line up pretty nicely with a diagonal resistance line. Then coming back down, trying to form up support on top of the 9 EMA instead of resistance below it, which is where we currently are. And then that would set up a really nice breakout trade to the upside. Again, not on the radar this week, probably need at least one more week of development on silver. So going out to the heat map, just to wrap up, this is the 1 week performance looking at last week, and you can see we are all over the map. There is not a single sector right now that is really holding up well. It is just a choppy mess. So this really drives home the importance of being very, very selective on the trades that you take. I will probably be sticking just to the major indexes this week instead of trying to take pop shots at any one company. We are still in earnings as well. So have a lot of earnings coming up this week. Make sure that if you are trading individual stocks, you are aware of their earnings date, and make sure that you have at least 10 days to be able to get in and out of your trade before that earnings date occurs. And with that, take care, guys. Trade safe. As always, let me know if you have any questions in the comments.